Everyone thinks Tesla makes money selling cars. It's the most valuable car company on Earth, so the cars must be where the profit is. But look closely at the year Tesla first turned a profit, and the story falls apart. In 2020, Tesla reported $721 million in net income, its first profitable year ever, the moment Wall Street had waited a decade for. There was just one problem. That same year, Tesla booked $1.5 billion in revenue from something called regulatory credits. Do the math. Strip out the credits, and Tesla's first profitable year wasn't profitable at all. It was a loss. The cars didn't make the money, something else did. So what exactly is a regulatory credit? Governments around the world set rules on how much pollution automakers are allowed to sell. If you build gas-burning cars, you rack up a deficit against those rules. If you build zero-emission cars, you earn credits. Tesla only builds electric cars, so Tesla generates an enormous surplus of credits it will never need. And here's the beautiful part. The automakers who can't meet the rules are legally required to buy those credits from someone. So Ford and Stellantis, and a long list of others, write checks directly to Tesla, their competitor, just to keep selling their own cars. Think about what that means. This is revenue with almost no cost attached to it. Tesla doesn't build a factory to produce a regulatory credit. It doesn't buy steel or batteries or pay a worker on an assembly line. The credit is a byproduct. It already exists, simply because Tesla sold an electric car it was going to sell anyway. Which means nearly every dollar of credit revenue falls straight to the bottom line. It is as close to free money as a public company ever gets. In an industry where making a car and selling it at a profit is brutally hard, Tesla found a side door where its rivals pay it, at nearly 100% margin, for the privilege of staying in business. And this wasn't a one-year fluke. Tesla has been quietly collecting this money for over a decade. In 2019, credits brought in around $600 million. In 2020, more than $1.5 billion. And instead of fading, the number kept climbing, past $1.5 billion, then higher still, reaching well over $2.5 billion in a single recent year. Add it all up, and Tesla has pulled in close to $9 billion from selling regulatory credits, money that costed almost nothing to produce, money that came not from its customers, but from its competition. For years, this was the difference between Tesla being a profitable company and an unprofitable one. The narrative was electric cars. The engine was regulation. But if the credits were doing the heavy lifting, a fair question is, what about the cars themselves? Surely, at Tesla's scale, selling cars is a gold mine. This is where the second surprise lives. For most of Tesla's history, the car business has run on far thinner margins than its stock price would suggest. And lately, those margins have been shrinking fast. At its peak in 2022, Tesla's automotive gross margin, the profit on each car before all the corporate overhead, reached nearly 30%. For a car company, that was extraordinary. Traditional automakers often live in the low teens. But that peak didn't last. Starting in 2023, Tesla did something a confident monopoly does not do. It slashed prices, again and again, across its entire lineup. The goal was volume. Flood the roads with Teslas, protect market share against a wave of new electric competitors. And it worked, on volume. But the cost was margin. Within about a year, that near 30% automotive gross margin had fallen to around 18%. Tesla was selling more cars and making less on each one. So why would a company deliberately crush its own profitability on its core product? Because Elon Musk has never really been in the business of selling cars for a profit today. The strategy has always been to sell cars close to cost, sometimes at a loss, once you account for everything, in order to buy something the balance sheet doesn't show. Scale, data, a fleet. Every Tesla on the road is a rolling sensor, collecting billions of miles of driving data. Every buyer is a future customer for software and services. The car, in this worldview, is not the product. The car is the delivery mechanism. a way to get Tesla's real assets onto the road and into people's lives, subsidized by the customer who thinks they're just buying a vehicle. That reframes the regulatory credits entirely. They were never meant to be the destination. They were a bridge, a way to keep the company alive and technically profitable during the years when the cars couldn't carry the weight on their own, and while the more valuable engines were still being built. Musk knew the credit gravy train had an expiration date. As every other automaker races to electrify, they stop needing to buy credits, and eventually, they start earning their own. The single most profitable line on Tesla's income statement is, by design, a melting ice cube. A company that depended on it forever would be in serious trouble. Which raises the real question, the one that actually explains Tesla's valuation. If the credits are fading and the car margins are compressing, then what is the machine that's supposed to make Tesla one of the most profitable companies in the world? The answer is that Tesla has spent these years quietly building not one replacement engine, but 3. And none of them are about selling you a car. The first replacement is software, and specifically, the thing Tesla calls full self-driving. Here's why it matters to the money, regardless of what you think of the technology. When you buy full self-driving, you pay thousands of dollars up front or a monthly subscription. But Tesla doesn't get to count all that cash as profit the day you pay. Because it promises future updates, it has to recognize the revenue slowly, over time. So it sits on the balance sheet as deferred revenue, billions of dollars of cash already collected, waiting to be turned into reported profit later. And when it finally converts, software carries almost no marginal cost. Writing the code once and beaming it to 1 million cars costs Tesla close to nothing per car. It's the same magic as the regulatory credits, near total margin, except this time the money comes from customers and Tesla controls the spigot. The second engine is energy. Quietly, while everyone argued about cars, Tesla built a business selling giant batteries, home power walls, and utility-scale megapacks that store electricity for the grid. This used to be a rounding error. It isn't anymore. Tesla's energy generation and storage revenue climbed from under $3 billion to roughly $10 billion in just a few years. And here's the kicker. The gross margins in energy storage have, at times, run higher than the margins on the cars. The part of Tesla almost nobody buys the stock for is now one of its fastest-growing and most profitable arms. The third engine is the network. Tesla spent years building the largest fast-charging network on the continent, and for a long time it was a walled garden. Only Teslas could use it. Then Tesla opened it up. One by one, rival automakers adopted Tesla's charging standard, which means their drivers now pull into Tesla's stations and pay Tesla to charge cars Tesla didn't even build. It's a toll road. Once the concrete and the chargers are in the ground, every extra car that plugs in is high margin, recurring revenue, again, paid in part by the competition. Now step back and look at the whole picture. A company that sells cars near cost to put a fleet on the road, to harvest data and sell software at almost pure margin. That collects free money from regulators today and replaces it with energy and charging tomorrow. And that funds all of it with a stock price built not on this year's cars, but on the option value of autonomy and energy. A valuation so high that Tesla can raise billions of dollars in capital by selling just a sliver of stock and pour it straight back into the machine. That is not how a car company works. That is a financial flywheel wearing a car company's body. So the next time someone tells you Tesla is overvalued because it only sells a couple million cars a year, remember what you just saw. The cars were never really the business. They were the price of admission, the device that gets everything else onto the road. Because everyone thinks Tesla makes money selling cars, and that has almost never been the whole truth.